Global markets have been gripped by volatility this week as concerns about the coronavirus have intensified. The FTSE All-World Index has shed around $5 trillion since the peak in January as the equity meltdown extends into its fourth day this week. So where next for markets, and how concerned should we be about the impact on the global economy? Joining me on set today is Joe Little, Global Chief Strategist at HSBC Asset Management. Joe, great to see you.
Hi, Victoria.
So I wanted to get your views about this sort of volatility that we've been seeing, obviously so much risk-off sentiment at the moment. I mean, do you expect that to prevail, or do you think it could be a case that that kind of bad news turns into good news in the sense that it might elicit a more stronger response from the monetary authorities like the Fed?
Okay, so it's a great question. One of the core themes that we've had for the macro environment that we think we're going to find ourselves in all year is the idea of the age of uncertainty. And what I meant by that really is that there's a lot of different forms of uncertainty that can come and challenge investors, challenge the market outlook, either coming from the macro space, coming from the political space, the policy space. So the events that we've seen in investment markets over the last few weeks, with coronavirus really becoming the front of mind issue for investors, we think is a new version of that age of uncertainty story. So I think the insight or the observation that's going to be the persistent one is the regime remains very tricky for investors, not an easy environment to be committing capital, and this age of uncertainty is the persistent and pervasive feature.
Yeah, it's interesting because, I mean, we had this sell-off in equities, but before that, even though they were trading at all-time highs, when we looked at the price of gold, for example, that was in a bull market as well. So clearly there was a lot of nervousness in the market already, even though it wasn't being reflected necessarily within equity prices. I mean, did the sell-off catch you off guard?
Well, we've seen a lot of moves in different asset markets. So depending on where you look, there has been bursts of episodic volatility, what we call episodic volatility, in different asset markets. If we look at commodities, we've seen some very significant moves over the last few days. Shipping indicators, for example, have fallen really dramatically. Copper prices, oil prices have performed also very negatively. Precious metals like gold, as you say, have performed a bit more strongly, as we would expect. Safe havens, offering safe harbour for investors. And then what we've seen is the pass-through of some of those episodic volatility elements into other asset classes. So global bond markets have now sort of repriced, discounted a much more cautious outlook for growth and inflation. We see the 30-year Treasury in the United States moving below 1.8%. That's a real significant milestone for global bonds. And equity markets also a little bit more anxious around the spread of the virus and the macroeconomic consequence of the coronavirus.
So what are you saying to your clients about sort of how to play this? Is this the time to get more defensive? Should we be looking to more defensive stocks? You mentioned the bond market, a lot of that sort of negativity already reflected into prices there. Gold prices already elevated. Should we be looking to safe havens and defensive stocks, or are we kind of jumping the gun?
Well, I think it depends. I think there's a lot of uncertainty in the near term about how the economic implications from coronavirus are going to play out. We thought that we were going to see a scenario this year of what I call slow and steady growth. There's a lot of question marks around that now. So it's likely that the first quarter of the economic performance, global economy, is going to be really quite challenged, quite disappointing. After that, though, we may be beginning to see signs of improvement. Policy support is coming in, manufacturing sector improving, inventories rebuilding. So we could see the beginnings of a bounce back and a recovery in macro performance as we move through the year. And if that's right, then there are some opportunities in investment markets for investors to really refocus on some of those growth stories that have been punished in recent market action. So
in terms of the coronavirus itself, I mean, we've had 80,000 people across 40 countries that have been infected so far. I mean, has the scale of this surprised you? And you mentioned the fact that there could be some kind of a bounce back. Does that mean you think that this is relatively contained and that it's just going to be reflected in the first quarter and not necessarily the quarters after that?
So there's lots of uncertainties.
Yeah, of course.
It's hard to make a bold forecast.
Yeah.
I think that's not something that we want to be doing as investors. We want to be thinking about where the opportunities are and positioning portfolios on a diversified basis accordingly. So you have to be a bit open-minded, watch the data closely, see how things play out. The next few weeks are going to be very important to sort of understand how the trends develop and play out. I do think, though, we're reaching a very important stage where we're moving away from the sort of containment policies around the spread of the virus to more mitigation policies to sort of control things a bit more. And that puts us at a really interesting juncture in terms of the macro trends, because the coronavirus is a very significant demand shock for the global economy and also a supply shock for some Asian economies, particularly in China. As we move more to that sort of mitigation strategy, then there is an element of improvement that we can anticipate in terms of the macro trends. As I say, manufacturing sector beginning to improve, inventories being rebuilt, the global supply chain coming back online a little bit. And that will take time, and there's no guarantees. But if we do begin to see that trend play out, then that's the point where we can become more confident in the opportunity that may be being presented in some risk asset classes, particularly in global equities, particularly in parts of emerging markets.
So how should the portfolio be positioned right now, do you think? Can you give us a bit more clarity about sort of asset allocation, defensiveness versus risk, risk on versus risk off, etc.?
Exactly. So if we think about a multi-asset strategy, one of the key elements for how we determine that asset class shape, that portfolio shape, is the valuation opportunity, so the relative return opportunities, and then also the risk consideration around the macro trends. Lots of uncertainty around the macro trends. So I think we want to be a bit cautious in how we're doing active positioning in the portfolio. But broadly, strategically, the key valuation opportunity that I think investors need to have at the front of their mind at the moment is that the valuation opportunities are quite stretched at the moment. What I call the capital market line, which is the set of valuation opportunities in global markets, is quite steep. Global bonds have rallied very strongly in this recent episode, and that means that the rewards that are available in parts of global bonds are quite poor now, significantly below inflation in many global bond markets, and that's not a great reward for investors with medium-term time horizons. But if we go out along that capital market line into more volatility asset classes, markets like global equities, Asian equities, emerging markets generally, the relative rewards do look much more attractive on a risk-adjusted return basis. So I think that the portfolios, we continue to need to be diversified, lots of uncertainty, but having that pro-growth exposure, continuing to have a focus on global equities, emerging markets, broad sense of diversification around some of those growth strategies, that continues to make sense. Valuations are tilting us in that direction, and if the macro trends begin to play out as we think they will on our base case, lots of uncertainties, but if we think those trends will play out as I've said, then there's a good opportunity for to capture some nice opportunities in investment markets.
Okay, and just finally, I know it's not your base case, but there has been increased discussion about the risks around a potential global recession. Is that the kind of type of conversation that you've been having? Is this sort of an outside risk, say, within the next 12 months?
So, I think you're right. Many investors are very fearful at the moment. We can see that in how investment markets are performing, how equities are trading, commodities are trading. This sort of episodic volatility that we've seen in investment markets is very reminiscent of a market system that's getting more and more concerned about recession. There's no evidence for that yet in the macro data, but we wouldn't expect to see it because it will come a little bit further down the line. So I think we've got to be open-minded about that possibility and not sort of too arrogant in our beliefs or forecasts about the economy. It's not something that we see at the moment in the data. It's not in our base case. But we need to be thoughtful given the amount of uncertainty in the situation at the moment.
All right, Joe, thank you so much for your time.
Thank you.
That was Joe Little, Global Chief Strategist at HSBC Asset Management. I'm Victoria Scholar, and thanks for watching IGTV.